Well, hello and a very warm welcome to this Scope Ratings webinar, Outlook for CLOs, which we've subtitled Current Rally to Continue in 2022, along with changes on the horizon. My name is Keith Mullin, and it's my pleasure to be moderating today's session. Now, in a moment, I'll hand over to Benoit Vasseur, an Executive Director in Scope's Structured Finance team, who will take you through a short presentation outlining the key drivers of what was a very active year last year, and also offering his outlook for this year and discussing some of the CLO market's themes. After that, we'll be delighted to take your questions. Now, there's no need to wait until the end to post your questions. Please type into the questions box on the platform as we go along. Now, we have produced a research note on our European CLO outlook. A link to this will be made available towards the end of the session for download. So that's it from me. It's now my great pleasure to hand over to Benoit. Benoit, hi, great to see you. The floor is yours.
All right, thanks, Keith. Good afternoon, everyone, and welcome to Scope's European CLO Outlook webinar. Our aim this afternoon is to discuss how 2021 has been a banner year for the European CLO market. We will first focus on different metrics that illustrate the performance of European CLOs since the start of the pandemic. We will then give perspective on what 2022 could bring and highlight relevant themes for the upcoming year, namely Libor Transition, ESG in CLOs, and middle market loans. All right, let's dive into it. The first observation is that the European CLO markets have been very resilient throughout the pandemic. After a pause during the first lockdowns, coinciding with a general shutdown of the capital markets, Euro CLO issuance has sprung back to life since Q3 2020. This is illustrated in the top right chart, where we look at volumes per quarter and number of transactions. So the pause has happened in 2020 Q2, and since then, we've seen a steady rise in volumes, in number of transactions, and also we've seen larger transactions coming to the market. In total, for 2021, 39 billion of newly fresh CLOs have been issued. This is a record post the global financial crisis, and this corresponds to a 70% rise compared to 2020. Alongside this 39 billion of new issuance, more than 60 billion has been repriced or refinanced. So all in all, almost or about 100 billion of new CLOs have come to the market. This is pretty incredible given where we were only a few years ago. Alongside more transactions and more volumes, and this is illustrated in the bottom left chart, new managers have come to the market as well. We had five new joiners in 21, which bring us to more than 60 managers in the European space. This is a steep rise from, we had about 20 in 2014 when the market reopened fully. So this trend is likely to continue as the demand for the product keeps on growing. It shows the attractiveness of the asset class in general. What is noticeable is that there are now a few managers that have more than 20 transactions under their management, which is pretty impressive. So alongside elevated volumes, equaling and even surpassing, as we said, previous levels pre-pandemic, other metrics have caught up and illustrate that the Euro CLO market are beyond a recovery stage now. And this is shown in the bottom right chart in particular, where we look at deal leverages. So in the baseline here, the 0% corresponds to the average leverage that we've seen in European CLO transactions since 2014. Essentially, positive numbers means that the leverage for the quarter in question is higher than this average. And we are seeing that pre-pandemic, we were slightly above this metric, meaning slightly more levered transactions. With the pandemic, we've seen a sharp drop in leverage for the new transactions that have come into the market just after the first lockdowns, essentially, and a steady rise from Q3 to right now, where now the leverage has come back to elevated ranges of levels, which indicates that there starts to be some pressure in terms of spread arbitrage, and also is indicative of the large volumes that we've seen. Now, the next slides give an overview of the different spread metrics across CLO tranches sorted by different rated categories. Please note that in this slide, the numbers corresponds to spreads based on primary markets for new CLO then, and not secondary markets. So similar to the previous slide, I think the main observation is that after the stress of 2020, we're back to levels that are more comparable to what we saw pre-pandemic. This is illustrated by this first table, which shows the mean spread per rating category for the time period in question. So if you compare, you would really see that levels in 2020 were much higher than pre-pandemic, and the levels in 2021 are below these 2020 levels. However, one thing to note is that throughout the year we can see a steady rise in these mean spreads for almost most rating categories, which indicates the start of pressure that we can see, and that comes from elevated volumes. Of course, with more supply, investors will ask for more spread going forward. The bottom left chart is another way of depicting this phenomenon. Instead of looking mainly purely at means, we've graphed the distribution of spreads for each rating category in average for deals European CLOs issued from 2014 to up to Q4 2021. The dashed line, vertical lines, corresponds to the levels seen in average in Q4 2021. It's interesting to see the argument of normalization, essentially. You can see that most of these vertical lines are close to the peak of the distribution, which essentially, explain or highlights the fact that we're back to a more, let's say, normal level of what we've seen pre-pandemic. The exception is perhaps the double B category, where we are more towards the right-hand side of the distribution, which indicates further spread, like maybe a perceived higher risk in that rating category from investors. Also due to elevated volumes, as we discussed. The chart on the bottom right is the evolution of the Euro CLO spread arbitrage, which we define as the difference between spread of the assets and spread of the CLO tranche liabilities, essentially. Like the level of this spread arbitrage will essentially give an idea on how possible or easy or it is to issue new CLO transactions, and gives also a sense that the leverage that is needed to do so. We can see that historically, in comparison to the previous year, we are in the tighter ranges, and this is also explained by more benign condition on the leverage loan side, and spreads on the CLO tranche that are creeping back up. So this raises question about in general what managers and arrangers will do in order to issue new transaction. Are they going to use low rated collateral to increase the spread? Are they going to make transactions with higher leverage? We will see. I think the one element is the volatility that we've seen in Q, or at least in this first month of 2022, perhaps helps a little bit this metric with leverage loan spreads slightly up. All right, the next slide, these slides focus on CLO Portfolio Matrix, and it highlights how CLO portfolios have slowly recovered from the stress of the pandemic. We've chosen a few metrics to illustrate this. So first, bottom left, triple C asset and CLO portfolios. It is a good metric to follow because the proportion of triple C asset in a CLO is covenanted, and if one portfolio has an excess of this asset, it will impact the collateralization test and whether or not cash flow can be paid to certain tranches. Has assets that are triple C assets that are above a certain threshold will be then valued at market price rather than at par value. So one can see that this matrix has improved since since 2020, essentially, where we had a much higher proportion of deals who had 7.5 and more percent of triple C assets in their portfolio. The covenant is usually at 7.5%. This is where the limit is set. So we're trending towards normalization here there. Another metric that one could look at is the number of assets priced at 90% or below. It matters if managers want to trade in and out. They would obviously need to recognize a par loss if they do at levels below 90 for sure. Some transaction also oblige the manager to account for these assets or assets below a certain value to be accounting at market price rather than par value. So here as well, we can see that there's a steady improvement towards having less of these assets in the portfolio in line with general market recovery. The last graph on the bottom right-hand side is a depiction of how the pool rating factors are evolved based on Moody's metric when the deals are issued. You can see that in 2020, clearly there has been a jump at the moment where new CLOs have been issued. With a normalization toward the end of 2020, 2021 has been pretty steady, and we almost go back to the levels that we had in 2029, although slightly higher. So whole points to some normalization for sure, less volatility, albeit the levels that we see in these different metrics are not entirely back to where we were pre-pandemic. And this is in the light of the remaining headwinds that are still there. Of course, new variants, progressive tapering of the government helps, etc. So in summary for 2021, this has been a year of very elevated record volumes. We've seen recovering portfolio, although not back to total normalization or benign state. And the spreads have been generally back to tight levels or more normal levels, but we've seen a gradual widening throughout the year in the light of elevated volumes. So where does it lead us to for 2022? So essentially, first, we can take a look at what would be the supply on the leverage loan side. So as mentioned, the start of the year has been volatile. However, the leverage loan issuance has been healthy in the month of January. In the European side, despite inflation pressure, we expect the ECB to increase rates only after 2020. So this should ensure still relatively cheap funding costs for the high yield borrowers. On top of this, growth prospects are still relatively healthy, still recovering from the initial pandemic shock. So this should provide a good outlook for further issues. And on top of that, we can expect M&A and issuance of leverage on the back of this activity to be healthy, as illustrated by a continuation of 2021, really, perhaps not at the same elevated levels due to the volatility that we're seeing in the markets, but there is a lot of dry power still in the market to invest, and I think this M&A activity will be still supportive of the leverage loan market in Europe and in general CLO creation. On the demand side, there's a few dynamics that can encourage a busy year 2022. We talked about inflationary pressure. In general, investors will favor floating rate products, investment products, and CLOs are on the forefront of this. We mentioned there are more managers. More managers will create more opportunity or will want to issue new deals to establish themselves or build their AUM. And we expect as well, or at least the conditions for refinancing or repricing will be perhaps slightly less positive than last year, which was particularly active on that front with over 60 billion of repricing refinancing. Therefore, the focus might be more on the fresh new CLO, if you want, which could help. In general, we still expect elevated volumes, perhaps not at record levels, but I think a lot is to come for 2022 in the European CLO world. So now let's discuss a couple of themes that could shape the European CLO market or could be discussion points. So first of all, the Libor transition. This is actually a topic that impacts the whole financial market in the US world, continental world, and obviously UK world too. So how does it impact a CLO, the European CLO in general? So I would say not so much as of now, but clearly this is a topic that will be more prominent in the month coming. The idea is that Libor should be the transition from the markets and replacement indices needs to be used. In the UK, the Libor is not available anymore, and SONIA rates are used now. It's not really impacting CLOs because purely sterling CLOs are not common. In the US, we see the use of the SOFR, the secured overnight financial rate, more prominent, and we've also seen the transition in some deals where some CLO liabilities have been issued using this index. This follows as well transition on the asset side. So the idea will be the same for Europe, where this theme will be more and more important when the deadlines are approaching. So the euro and short-term rate is used, well, as is getting more widely adopted in the euro space. So we will see how this develops. Certainly, this is something to pay attention to for CLO managers, especially if they want to or still want to use assets that are non-euro denominated, how to cope with the fact that there might be even more mismatches than before in terms of reference rates. Will they be able to use perfect asset swap or hedges to mitigate that risk? These are still open questions and interesting like themes to follow as they develop throughout this year and 2023. Another topic of importance in the CRO world and of course in financial market in general is ESG. Obviously, Europe is leading the way in the context of sustainable investment and its regulation. And for CLOs, it's also a topic that is becoming increasingly important for manager and investor alike. So we're seeing increased emphasis on this topic, and managers have taken action, if you want. So we are seeing more and more managers that are becoming pickier in the industries that they want to invest to, and essentially are restricting or excluding more industries in their investment portfolios. This is highlighted in this bottom left chart, where you see that essentially the criteria are getting more and more stricter in light also with the requirement from the investors. So essentially, negative screening has become more mainstream. We also expect CLO managers to further develop positive screening strategies and incorporate more sustainability criteria in their investment decision to make sure that it captures the needs of more ESG conscious investors. So a real key to this development is understanding how this positive selection or this screening is being done. Is it going to be done using internal scoring, internal policy guidelines, or a use of an external benchmark is going to be implemented? This has to be seen. For sure, it's something that investors need to be wary of and make sure they do their own diligence in terms of how robust the criteria are and how one could compare criteria between of different managers essentially. So need for benchmarking and standardization is there. Scope itself with the ESG analysis branch is providing ESG scoring, and this bottom right chart is a result of an analysis that we've done on a portfolio of leverage loan issuers compared to companies from the DAX and CAC 40. This is part of a previous piece of research that we've published, and it's also a theme that we want to develop further. So probably more to come on that front from our side. In general, there's positive momentum on this topic, and this is illustrated with also a transaction in the European transaction that has priced in Q4 2021, and that is aligned with the Sustainable Finance Disclosure Regulation Article 8. So this trends towards the right directions in terms of disclosure comparability on that front. And lastly, we would like to discuss the middle market loans alternative in CLO portfolios. So this is something that we see in the US market, where you have dedicated US middle market CLOs. With the rise of private debt in general in Europe and in US as well, but and direct lending in Europe, we see that there's possibility or opportunities for CLO managers to incorporate more such of this type of loans in portfolio. This would be a differentiating factor. We also see that like there are companies that are maybe be deemed too small for leverage loan CLOs that have the ambition to go more to the syndicated markets and perhaps get a bit better pricing. So in general, I think the two words of private debt, direct lending, and CLOs are perhaps start to overlap slightly, or at least becoming to overlap, or getting now closer together, closer from each other. Therefore, it could be something to follow, see if CLO managers are able to incorporate more of this, let's call it more private debt type of loans in their portfolio, knowing obviously that there are constraints with regards to liquidity that might be less than, let's say, more leverage loans, syndicated type of assets. Some transaction documentation might be slightly tweaked, but in general, this could be a way of differentiating oneself, especially in the light of leverage loan portfolios that are becoming very overlapped in the recent years. Obviously, private debt gives the also advantage of most likely higher yield and more bespoke terms in terms of governance and security package. So in light of how this market has developed in Europe, it would not be surprising if this trend arise in the, let's say, more traditional leverage loan CLO market as well. So also something to follow for 2022. So with that, I thank you a lot for your time, and I give it back to Keith then.
Great, thank you very much, Benoit, for that very detailed presentation. Indeed, lots of this key theme ahead. So as I mentioned at the beginning, Benoit is happy to take some questions. So if you do have questions, feel free to type them in the next minute or two. Benoit, while we're waiting for questions, maybe I can put one to you, if I may. You talked about the ESG CLO from the supply and the demand side. Now, in the bond market, we've seen examples where issuers are able to generate a better cost of funds through their green and ESG funding than through their conventional funding. Would your expectation be over time be that ESG heavy CLOs would actually offer managers the chance to achieve better execution in the primary market?
I think this is possible as long as investors are convinced that the way the ESG criteria of that particular manager are robust and reflect criteria that make sense and are aligned with with other benchmarks in the industry. And I think, like I mentioned, the CLO that is like that was aligned with the SFDR regulation, Article 8. I would see if, CLOs that are sticking to upcoming regulation or recommendation gaining more demand and from the investor side, and as a result, all things being equal, being able to achieve better pricing, possibly, yes.
Yeah. Okay, so your general thrust was quite positive with regard to both issuance of leveraged loans, the kind of interest rate environment you talked about as well. What are your what do you see as potential challenges to the European CLO market this year? Anything particularly stand out away from black swan events? I'm talking about sort of general market developments or corporate developments.
Yeah, sure. I think, as I mentioned, like the arbitrage, the spread arbitrage is pretty tight, and we might see a tendency to incorporate lower rated assets in the portfolio, lower the quality, the base quality of the portfolio, which in combination with, let's say, uh, events such, increase of rates or, like as I mentioned, the tapering of government had, could put pressure on these, let's say, weaker borrowers, and therefore achieve a little bit of a situation where you have uh, structure that are structured tightly or aggressively with collateral that might perform badly or be downgraded, which could put the structure underwater quickly. So that's one risk. It's obviously trying to over engineer in combination with deteriorating macro backdrop.
Okay, yeah, thanks. There's a question that's come in, Benoit. Let me give you a chance to take a look at the question, and perhaps I can put it to you.
Yes, no, thanks a lot. I see it. Yes, so I would say first of all, the question is about this last slide that is still in on the screen, and middle market loans. Are we expecting middle market loans to be incorporated in the broadly syndicated loan CLOs, or are we going to see the emergence of middle market CLOs in Europe, like as we've experienced in Europe, in the US? Sorry, I think I would say this would be progressive. So it's perhaps easier to tweak slightly the conditions of a broadly syndicated loan CLOs with a bucket of such type of loans, or tweak certain elements, which obviously will make the capital structure a little bit different, and some of the management rules too. I think it's easier to do than a fully fledged middle market loan CLO. That being said, this is I don't see why it's not possible going forward. My expectation is this will come, especially if the private debt markets continue to rise in importance. So I would see first an inclusion of a bucket of such type loans in a more traditional transaction than a fully fledged middle market here.
Yeah. Okay, then another question, Benoit, has come in, which perhaps you can address, which is about diversification across issuers, and in the light of possible M&A activity, do you see any increment of overlap of issuers across the European CLO pools?
Okay, so this is a metric that we've been following. Obviously, we can't follow as closely as our competitors. That one, my expectation is that this diversification aspect is not, is not getting better. So the overlap is larger in my view, because uh, the large issuer tends to refi and essentially issue bigger loans that are taken up by the CLOs. So this overlap, I would say, phenomenon is there to stay. I think now a counterbalance to that point is also like more managers coming to the market, and I think at some point it's about also trying to manager will try to have their own angle and perhaps try to find collateral that is um, less less traditional than others, or have a certain view on that. And to the point as well where with overlap, if also a lot of managers tend to restrict industries because of ESG concerns, in some way you're reducing the your universe of possibilities. Therefore, the overlaps also mechanically grow. And this is why I think the middle market loan is an avenue. Uh, it's really also showing that you can build a portfolio that is also different than the others.
Okay, thanks. So we'll close, unless there are more questions, we'll close in a second. So if you have that burning question, please do type it in now. And while we're waiting for that final question, but perhaps we can bring up the link to the report that I mentioned at the beginning that was published recently. It's on the website, but we can bring the link up, then perhaps those of you who are still logged on could actually download the report now. So can we get that link? And there we are. We'll give you a few seconds just to click the download now button, and a final call for any questions. No, Benoit, looks like you've done almost a perfect job there in answering all potential questions. So thanks for that. So let me close the session now then, if there are no more questions. Thank you, Benoit, again for your presentation. Thanks to you for dialing in. We do at Scope, we do a lot of these sessions as a sort of market communication exercise and investor outreach exercise. And so we will do these things on structured finance and other areas of the market over the course of the year. So please look out for them. And we'll look forward to the pleasure of your company on a future date. So with that, I'll close the session, and I wish you all a successful and safe rest of afternoon. Thanks a lot, and it's bye from us.
Thanks a lot. Bye-bye.